The annual IHS Cera Week conference here in Houston, often known as the Davos of Energy, is probably the best place in the world to gauge the condition of the global oil industry. You don't see much visible evidence of hardship here. Attendance was a record 2,800. But in the words of Lamar Mackay, Deputy Chief Executive of BP, conditions in the oil business are brutal. 2 years ago, executives were complaining that the high cost of complex oil projects, such as fields in deep water, meant it was hard to make adequate profits, even with oil at $100 per barrel. Since then, the price of oil has slumped to its lowest level for more than 12 years. It's now languishing at about $35 per barrel. The reason? The boom in US oil output, made possible by advances in production technology. US output had been in long-term decline, but between 2009 and 2014, the US brought almost 5 million barrels per day of additional crude supply onto world markets, creating a glut that drove prices down. When he spoke here on Tuesday morning, Ali Al-Naimi, Saudi Arabia's influential oil minister, said he planned to stick to the same strategy that he'd been pursuing since November 2014, and that meant refusing to restrict production in an attempt to support the price of oil. Instead, he said, the oil market would be brought back into balance a different way, by higher-cost suppliers being forced out of business. His message to high-cost oil companies was that they had three choices. They could cut costs, they could borrow money, or they could liquidate. As many companies are coming to the limit of what they can borrow, and most would prefer to stay in business, that leaves one option. They have to cut costs. An estimated 250,000 jobs have already gone from the oil industry worldwide, with almost 100,000 in the US alone. Halliburton, one of the world's largest oil services groups, last week announced a further 5,000 job losses, having already reduced its workforce by 22,000. Oil executives don't expect to see $100 crude back again anytime soon. If the price gets much above 50, then shale drilling in the US, which has been hit very hard in the downturn, is likely to pick up again. And if that happens, then US production could start rising too. In effect, it'll put a cap on prices. The name of the game for oil companies today is working out how to survive if oil stays around $50 or $60 per barrel. These brutal conditions look likely to be around for a while. Ed Crooks for the Financial Times in Houston.